All right, I'm going to give a little talk on what I think is going on. It's very difficult to know, as the title of my talk suggests. And then I have some lovely companies up here who can give you updates on what they're doing. So let's get started. I really think right now the most important framework for investors is to not try and know what's happening in the near term, because we're just in very uncharted waters, and the data is very mixed, and it's and the reaction is very data dependent. And so trying to predict what's going to happen tomorrow, whether you're talking about the S&P or gold or copper or oil for that matter, is really difficult. Your odds of success are low. But I think if you can take a medium-term horizon, I think your odds increase significantly, at least in the metals arena. So that's my framework, and I'll sort of run through that in the next 15 minutes. Okay, so looking back a bit, obviously inflation was already ramping all through 2021, but it was like the elephant that nobody wanted to acknowledge was in the room. We were like, yeah, sure, inflation, we'll talk about it, but we won't actually do anything about it. We'll still invest and operate as though it wasn't happening. But then in Q1, the numbers got extreme, and then Russia obviously poured fuel on the fire, and the need to fight inflation became undeniable. And that was a tough pill to swallow, right? The reality, the thing that happened to the broad markets is that the reality of tightening set in. Market reaction be damned. If you go back and look through pundits talking all through 2021, right till the end, even at the beginning of January, people were saying, oh, but the Fed put, which means if the market starts to slide, the Fed will step back. Like that's what's happened over the last decade. The Fed won't push the markets too hard. And so nobody was that worried in the markets about tightening, because they assumed that the Fed would step back if the market reaction was extreme. But you can't step back when inflation is as extreme as it is. And so the market reaction be damned, reality of tightening is what has happened in the last few months. I mean, I don't need to put these up for any of us to know that it's been a tumultuous time in the markets. Now, of course, the reason that I'm talking about that in a mining conference is that the broad markets matter. And here I'm going to step back and paint a bit of a broader picture. Since the great financial crisis, when monetary responses to stock market crashes became such an established thing, the risk paradigm has shifted, right? Every risky bet, almost, I mean, I guess I shouldn't say everyone, but until a few months ago, almost every risky bet paid off. Dips were always, very reliably, dips were buying opportunities. And when we saw that develop over the great financial crisis and the response to that, of course, the Fed and other central banks learned what it took and how much it took in terms of quantitative easing and how long it took in terms of negative interest rates to create that or restore that market stability. And then when COVID happened, oh my goodness, did they ever pour it on, right? Take what you've learned and do it sixfold. And so monetary policy stopped the COVID crash. And that just cemented the idea that the Fed was there to backstop risk, right? And so risk taking went wild. I mean, money poured into really, really crazy things over the last few years. And so that, of course, shifts when the Fed is forced to shift, right? And that's that whole market reaction be damned thing. The Fed has to change direction. And it's within context, this is a very big deal. So the key forces that push the markets up so much, and one of those that I like to point out is that there was immense demand for tech products during COVID, right? One of the examples that I like to quote is Apple had reliable something like 3.9% growth, annual growth year over year for like many years. And then in 2021, it grew 33% because everybody needed to buy iPads so that their kids and everybody could work from home. And so it really pulled forward a lot of demand for tech. And of course, tech companies were the leaders of this broad bull market. So there was all these compounding forces between the Fed backstopping risk and a huge pull forward of demand for tech products and tech companies being leaders in the market that just really pushed these things skyward. And that is all now reversing, right? When you pull forward demand, it doesn't exist down the road. I mean, the year over years for Apple are going to be crappy because people aren't buying iPads this year. They have more iPads than they now know what to do with. And so the year over years for those tech products are bad. That's been a big factor. And then, of course, the monetary response has reversed. Now we're in a dramatically inflationary environment, and we're facing tightening instead of support. So then the big question is, will the Fed step in to backstop risk again? And this is the one, to me, this is actually the biggest question, especially for gold investors. If the Fed steps in again and risk is supported once again, that I don't like very much as a gold investor, because gold has always held its appeal as a reasonably rare opportunity. And that opportunity was a pairing of risk and high reward. And that's what created these massive gold bull markets, right? That when gold started to go, yes, there was risk because it's exploration and whatnot, but there was great reward on the table. And that's what brought so many investors onto the boat. And that's what pushed the tide up when you had these gold bull markets. But when you have a proliferation of high return, high risk, but high return opportunities available in the market, that just reduces the appeal of gold equities. So if risk is taken off of the table more clearly, then I think that that paves the way better for gold to reestablish some of that risk return market share. If the Fed backstops risk again, then I think gold equities will remain a bit in the muddle amongst all of those other opportunities. Let me be clear, I think gold is going to do well, but as we've seen over the last while, gold equities haven't been enjoying the returns that gold has been enjoying. Okay, so what's next? I mean, I don't know. That's what I started the talk by saying. I don't know what's next. I mean, I think the best case scenario is that we sort of muddle along from here with continued growth. These are what the forecasts say. Forecasts are hardly worth anything. And we muddle along with growth until inflation comes down. You can argue this till you're blue in the face in both directions. I think for the last several weeks in my newsletter, I keep titling my editorial something like mixed messages, because the data is just, I get all this data in my inbox every morning, and it says as much for as it does against the markets, like a recession. And so you can say that there's no good reason for the markets to rally because inflation is not going to just suddenly plummet. There's lots of reasons to think that inflation is going to come down, but it's not going to plummet, blah, blah, blah. But then we also do have some good signs of economic strength, right? We have very low unemployment, which is very important in a consumer-driven economy. If people have confidence that they will remain employed, then they can continue to buy. And so that is very important in a consumer economy. And then household wealth is high, very correlated to the stock market, so that knife cuts both ways. But anyways, so that's the best case scenario. What's next are worser and worstest scenarios. You could have a crash, you could have stagflation. There's things that can happen. I don't know which it's going to be. So sorry to lead you to nowhere. This is sort of an example of that kind of mixed messaging, right? So economic growth and investing come down to how much money people have that's available to put into things that isn't food and rent or mortgage payments and things like that. And yes, real liquidity is pointing to a sharp slowdown. But like I say, you can pull up the next email in my inbox on the same day that I got this one, and it would argue things the other way, like household wealth, low unemployment, consumer spending. So the messaging remains very, very mixed. Within all of that, though, I started by saying, if you can look past this immediate moment, and this immediate moment is going to persist for 6 months, 8 months, until we get some clarity on how and when and over what time frame it's going to take for inflation to come down. If we can look beyond that, then I think some very clear opportunities emerge. And the clearest of those is base metals. I mean, the green energy revolution is happening, and it is an incredibly strong driver of metals demand, right? I mean, I said especially nickel, copper, uranium. I should have put silver on that list as well. No amount of new capital can create the new nickel mines that are needed by 2024, 2 years from now, right? That's what we need. I mean, this is just the commodities index, and we know that that is doing very well. Stocks haven't really leveraged that dramatically. Base metal stocks have been doing okay. But I think what's really important is to just remind ourselves of the fundamentals for all of the metals that are infungible for the green energy revolution. We can't substitute copper for anything. So the green energy revolution can't happen without copper. And the middle of this decade, which is not very far away, we'll see the largest deficit in the copper market that we have ever seen. And yet, right now, there are no new copper mine in the world has been permitted in the last 2 years. I like the parallel. When was there last this much increase in copper demand? Well, it was back in the 2000s, right? When the Chinese development story was driving copper demand through the roof. The response from the copper market was immediate. As soon as it became clear, and yes, of course, it takes a while for the story to become clear, but once it became clear that copper demand was going through the roof, copper miners stepped up. They permitted new mines, they built them, investors were interested, capital flowed into the sector, and the supply response was very clear, and it happened in lockstep with demand. That is not what we are seeing today. Instead, now we're in a different permitting world where instead of 6 months to 2 years, roughly, maybe back in 2003, that might be what it took to permit a mine. Now it takes, 10 times that to permit a new mine. There's been very limited investor interest in the space, and the management in the large miners is incredibly conservative because of mistakes that were made a decade ago. And so you put those three things together, and there's basically been no supply response or very limited supply response to this incredible ramp up in demand. And what's the answer there? The only answer is prices going high enough to cause demand destruction for a metal that is not replaceable in the fundamental paradigm shift that's happening in the world. So if I sound bullish on copper, it's because I'm very bullish on copper. Nickel, very similar, right? I'm not going to dive into all of these in a lot of detail, but I mean, the nickel demand increases from EV batteries alone are just, they're difficult to wrap your head around, the scale of these demand increases. Silver, I know Chen and Peter will probably talk about this to some extent in their talks, but silver demand is going through the roof, and new generation solar panels are using way more silver. And even if they didn't use way more silver, we wouldn't have enough silver to make old school solar panels if silver took all of the world's supply in a few years. There isn't enough. And then there's uranium. And uranium, one of the interesting side effects of the Russian invasion is it has really boosted what was already on the table, but is now very foremost on the table, this resurgence of interest politically in nuclear power. It was happening, it was part of the green movement, but it was still a little bit touch and go. But now we're like, well, if we needed a little bit more impetus to try and move away from oil and gas, especially in Europe, here it is. This is the biggest impetus that we could have, and uranium is the obvious answer. It always was, but sometimes it takes a little bit of extra push. And guess what? There's not enough uranium either. Lithium is an interesting one, right? Lithium prices have already made an immense move. They will definitely come down from the levels they are at. I don't know what time frame that will take. But that's a really interesting number that Benchmark, who are the experts when it comes to lithium, estimate that it will take $42 billion in invested capital to meet lithium demand by the end of the decade. And the lithium market is not dissimilar from the copper market, where you're just not seeing that much capital inflow. You're seeing some expansions, but these things are so slow from permitting perspectives, from corporate conservatism. These things are very slow. And so this is just how it works. So as you may have surmised from everything that I've just said, I'm tilting these days a little bit away from gold. Don't get me wrong. I still love gold, and I still think that gold, the metal, is going to do very well over the next while. But because of this difference in the risk-reward landscape for investors, I think gold equities are getting a little bit lost in the muddle, and I think that explains, to some extent, the reason why, from the COVID crash until the end of 2021, gold, the metal, saw $23 billion in investor inflows. Gold miners saw $1 billion of outflows, right? That's the sort of contrast that captures, or that is pushing me towards this conclusion, where the gold equities are just struggling to stand out a bit in the new risk landscape. And then you have this bigger picture question of whether the Fed will step in. And if the Fed steps in again to clearly backstop risk, then the whole argument for gold cycles is just changed. It still exists, but it's changed because the argument used to rest on reliable economic and monetary cycles that were related. But if the Fed now operates differently, then those cycles are different. They're forever shifted. And so I think it just requires some thought. But at the same time, and while that's happening, the opportunity is still abundant in the mining sector because the green energy revolution is creating incredible opportunity for all of the metals that are needed for that. And at the same time, there's always still the fact that gold loves a market crash. So if we get one of the badder or baddest responses, right, we saw it in COVID. I mean, gold and gold stocks just roared out of the COVID crash. So if we get one of those worst responses, throw everything that I just said out the window and, go ahead and buy gold stocks because they definitely respond in that kind of situation. So I think I've said this, I don't know what's happening in the near term. I do have conviction that on the other side of this storm, we are going to have a great opportunity in metals, the metals that are infungible, that are needed, irreplaceable in the green energy revolution. I still believe that standout gold discoveries, Great Bear is the obvious example, right? We've had this muddle through gold market for several years, and yet Great Bear in that exact time frame gave us 100-fold return. Great discoveries, great projects. The gold miners still need to add new assets. Great projects will still generate good returns, so you just have to buy best of breed. And as we exit this storm, I want to make sure that I'm well positioned for exposure to the green energy revolution and with best-in-class gold companies. And I did that all without coughing. Yay! So thanks so much for listening.